In the last session, we just discussed with regard to a brief introduction with regard to what is, sources of financing and cost of capital. Let us focus on what is the meaning of sources of financing. Sources of finance refers to the various channels through which a business can obtain money to fund its operation, growth and other financial needs. Definitely, as I explained in the last session, as I mentioned in the last session, that is, sources of finance refers to raising of fund for a business, in order to run a business that can obtain in terms of that can obtain in terms of both, that is long term sources or short term sources of financing, or it may be on another concept on the basis of operation and a growth. We can call it as an internal sources of financing and external sources of financing. So, before starting of any business, it is a must for any entrepreneur or any company to, or any individual, to think about how do we raise a fund. So, what are the major sources, what are the major opportunities that has been available in and around us for raising of finance? That is a major concept. The next one, when I think about what are the opportunities that is being available for sources of financing, so it can be explained in two terms, that is internal sources of financing and external sources of financing. These are the two major and important pattern of financing of company, raising of funds to the companies. When we talk about internal source, it is clearly mentioned, internal, within an organization. Internal represents within an organization. External source represent outside the organization. So, these are the two major source of financing that has been held for raising of a fund. Let us go in detail. Internal sources of financing. Internal source of financing refers to the fund generated from within a business itself, that means through internal mode, rather than obtained from external lenders or investors. As I mentioned earlier, internals means within an organization, within an operation, that is within an operating profit that has been available in an organization. The good example that I can give you here for internal finances, that is internal source of financing, is retained earnings. So, what does a retained earnings? The amount after, when the profit has been earned after the distribution of dividends to the shareholders, the amount which is being kept in an organization is called as a, or retained in an organization is called as a retained earnings. This can be given as a good example. These funds are typically derived from the company's ongoing operations and assets. So, what are the basic characteristics of internal source of financing? No external obligation. So, the fund which is being raised internally within an organization by producing a product, sales and all the thing by selling of a product or sales of an asset, out of which we have been received an amount, based on that we have been raised. So, that does not mean like we have not been borrowed from an outsider. If we are borrowing, means we have to pay in two terms, whether in the form of interest or in the form of dividends. So, internal financing does not involve borrowing money or raising equity from outside the business. So, there are no interest payment, repayment schedules or dilution of ownership. Self-sufficiency. The second concept, key characteristics are self-sufficiency. That is, utilizing internal funds indicates that the business is capable of generating sufficient resources to finance its operation, investment and growth from its own activities. Definitely, when we want to raise a fund, it is not for only the initial, it is after that additional capital which has to be raised, and also in order to acquire the business, in order to merge the business, in order to expand your business. All these are the other way of growth of an organization, so or growth of a company. So, if we are generating internally and we are utilizing the retained earnings for the further expansion of a business, it indicates a positive note. That means we are not having any obligations from outside investor, rather we are being committed to our own profits, our own retained earnings that has been generated from our company. Cost effective. Since internal financing does not incur additional costs such as interest or fees, it is often more cost effective compared to the external financing. That is what, as we want to, if we are borrowing, we have to pay the interest, we have to pay the fees, or rather in terms of any commitments that has been meant. So it is often more very much cost effective rather than being external financing options. So these are the three major characteristics of an internal source of financing. What are the types of internal source of financing? Types in the sense the continuation, what are you have in the last slide just explained about what is internal source of financing. Here, what is that internal source of financing? As I told you, it is an internally available force. So the first one is retained earnings. What does a retained earnings means? Profits that are not distributed to shareholders as dividend, but are kept in the business to reinvest in operation, expansion or debt repayment. Or in other words, I can mention you as retained earnings, the profit which has been available, that is after a portion of profit which is being distributed to the shareholders, and after that what are the fund which is being retained in an organization in order to reinvest in an operation or growth of an operation, or in debt, or in order to pay the debt of an debt of a company, the retained earnings can be used. What are the advantages of this using of these retained earnings? That is no dilution of ownership. That exactly, it is a owner's fund. There is no dilution of an owner fund. No, we have been giving out of profit which is being generated from our business, from our own business. So that is more concept, and no interest cost reflects the business profitability and sustainability. Sustainability in the sense there are being consistent for while they are completely consistent while playing while giving an generating a profit to an organization. The second one is an depreciation fund. This can be one more sources of financing under internal source. Depreciation fund. What does depreciation means? Decrease in the value of asset. How do we purchase those asset? We purchase those the asset, fixed asset in the terms of financing these through retained earnings, through internal. If you are going through retained earnings means that is accumulation of asset which directly hamper the capital expenditure. So depreciation funds accumulated through accounting depreciation representation that representing the reduction in the value of fixed asset over time. As the day passes, there will be decrease in the value of a asset. So the major advantage, non-cash expenses that can be used for further asset replacement or maintenance helps in capital expenditure planning, definitely. Suppose if you take a car, if you have maintained well, if you take a vehicle, two-wheeler or four-wheeler, you have that has been maintained very well by giving in proper service and in proper showroom. The vehicle, it has been after going running, life of the vehicle would be of 10 years or 12 years, and after 12 years or so, if your vehicle is able to give a good performance, definitely would not like to sell it. So exactly in the same on the organization also, if a machinery is being well maintained, proper maintenance has been done, definitely it can be extended. Maybe the life of machinery have been come down, but by proper maintenance we can utilize those machinery for further use. So but year to year there will be a decrease in a value of an asset. That can be also certain kind of, that can avoid of purchasing of new asset, and that can be replacement maintenance cost might be increasing, but by proper maintenance we can use the same fund, I mean the same asset, so that replacement cost will be avoided, and further extra additional cost that has to be incurred for after replacement installations, all those things can be avoided. So this, and also the major depreciation fund also protects from tax. The next one is sale of asset. what does the sale of asset means? Generating funds by selling non-essential or underutilized assets such as machinery, equipment or a property. Underutilized, we have been not utilized. If we have our own property, that we can sell it off and we can use it off to our business. That is, the cash which is generated out of selling of an asset would be called as another source of internal financing. What are the advantage? When I tell liquidity, that is a quick way to raise cash, helps streamline operations by disposing of obsolete or surplus asset. That means that if we have an asset, definitely if we have any obligation with this asset in the form of machinery or equipment or a land, the property is nothing but your land and building, we can sell it off and out of that we can get the quick cash, so that we can convert that cash into business. The next one is owner's equity. Owner's equity is capital contributed by the business owner or a shareholders, including the initial investment and any additional contribution made over time. Okay, that is contribution, that is I being an owner of a company, I am being contributing to my own company, that is what we call it as an owner's fund, or a shareholders. Shareholders by issuing of an equity shares, that is shareholders includes initial investment, any additional contribution. For example, additional contribution in the sense issuing of an shares, we always think about IPOs, that is initial public offering, whereas when we think about internal raising of a fund, existing shareholders, if you want an additional capital, existing shareholders will be given an opportunity. I repeat, existing shareholders will be given an opportunity to buy the share, which is called as rights issue of a share. That can be given as an owner's equity fund and also can be given as an example. The advantages of this is increases the owner's stake in the business, no repayment obligation, demonstrates owner commitment and confidence in the business. So these are the different types of internal source of financing. The next concept is external source of financing. We just got to know internal means, which is the term that is retained earnings, depreciation fund, sale of asset, and owner's equity is termed as an internal financing. External means outside. That is generating a fund which is the outside, that is raising capital from investor. External source of financing refers to the fund obtained from outside the business, typically through borrowing or raising capital from investors. These sources are used to finance business operation, expansion and other financial needs when internal funds are insufficient. As I mentioned earlier, when we try to focus first on internal source, if not then we focus on external source. When in the internal source are sources of funds are not sufficient, we try to focus on raising a capital on an external source. What are the key characteristics? Just opposite to the internal. That is external obligation. External financing involves entering into agreements with lenders or investors, which often include repayment terms, interest payment or sharing ownership and profit. That is, we are in the internal financing, we just give an option, that is there is no scope for obligation, but for external financing we need to be committed, because somebody else fund is being invested on our company. Why somebody will invest on our company without giving any without expecting anything. That is why we always think about obligation, either in terms of prepayment, in terms of interest payment or sharing an ownership or a profit. Next is in diverse options. The next characteristics is business can access a variety of external funding sources, each with its own terms, condition and suitability for different needs and stages of business growth. That exactly diverse option in the sense we have got various opportunities to raise our fund, either in the form of debt or in the form of equity. It has always been better company raise in both the terms, because it can hedge against risk and return. The last one is potential cost. External financing usually comes with the costs such as interest, fees or dilution of ownership. Make it important to carefully consider the terms and condition. That is, potential cost is the cost which has been incurred on a business also been included in a business, that is the cost of interest, that is interest that we have to pay, fees and the maintenance cost, dilution of ownership, making an important to carefully consider what are the terms and conditions before giving before setting up of an obligation to external sources of financing. Now, under external source of financing, we have got different types. Okay. The first one is debt financing. As I told you earlier, that is internal source of financing is raising of a fund in an internally. External, we have got there, we have mentioned that there are 4 types of internal. Here we go on with the it can be stated as it can be stated as an example also. So, first one here is debt financing. Debt is an obligation. So, for under debt financing, I can give you an example, that is bank loans, okay, that is bonds and line of credit. Bank loans, borrowing a fixed amount of money from a bank with an agreement to repay it over a time with interest. Here we should not discuss with regard whether it is a long term loan, short term loan. Well, let us forget that. We just think about what does a debt financing means. Okay. But in external financing has 4 categorization: debt financing, equity financing, other alternative source of financing, and also the trade credit, the supply credit we do call it. But first we just discuss with regard to debt financing. So, as I mentioned, bank loans, okay. Bank loans, any amount which is borrowed from a bank would be represent agreement to repay it for over time with the interest would be called as a bank loans. Advantage, predictable repayment schedule, can be secured or unsecured, that is loan would be always in secured loans or an unsecured loans. This can be given as an example for concept understanding for a debt financing. The second one is bond. Bond is a long term debt securities issued by a company to investor, promising to pay periodic interest and repay the principal at maturity. That is what bond is. In it may be of government bond, it may be of private bond, but after purchasing of a bond, it has been specified duration and the time and the interest that has been paid. It is also a bond holder. The person who has a bond would be called as a bond holder. And what are the advantage? It is not been issued for only one person or 2 person. At the access for large sum of money, spread out of repayment, suitable for long term project. When we are issuing a bond, if we are suiting the categorization of project would be of whether it is for minimum of 1 year or 2 years, it is a project going to extend for 2 to 3 years. Based on that, the bonds will be issued. Third one is line of credit. Line of credit, flexible borrowing. What does it mean? A flexible borrowing arrangements with a pre-approved limit, allowing the business to draw funds as needed and pay interest only on the amount used. I can give you a line of credit in the sense overdraft. Bank overdraft can be also been given a good example for a line of credit, where flexible we can buy whenever we can get the loan whenever we want. If you have a current account, definitely based on my limit, the bank can issue above the limit. The bank can lend a amount above my limit, and that can be collected through called as an overdraft, and that fund can be drawn, and in return we need to pay an interest. Overall, debt financing is raising of a loan or raising of a fund. In return, we have to pay a interest. If I being a company, if I am raising my financing, okay, debt financing through the debt financing, in return I have to pay a interest. What are the advantages of line of credit? Flexibility, interest saving, useful for managing cash flow fluctuation. Definitely it is our own bank overdraft, definitely it will be interest saving in the sense monthly interest can be somewhere to the personal when we call when the companies goes for a longer duration of loan, the interest rate may be variable. Overdraft, it will be always lesser comparative to the other kinds of different types of loan available to the organization. The second concept here is a equity financing. So, first we just under external financing, debt financing, the second one is an equity financing. Equity financing means that means it is also called as an owner's fund, okay, which has been raised, okay, it can also be owner's fund. What are the different types of equity fund over there? Venture capital. Investment from venture capital firm in exchange for equity, typical targeting startups and high growth business. Venture, it's a new venture. If you want to start up a business, this type of capital is very much, when most of the company try to invest through an venture only. So, significant funding, potential for mentorship and strategic advice, no repayment obligations. That is mean if it is being fund raised through an venture, that doesn't mean that we have to repay it. That is, he is one among us. So, due to that, the repayment obligation will be always low when it is compared to a debt payment. Debt financing. The second one is angel investors, that is wealthy individuals who provides capital to early stage business in exchange of ownership of equity or convertible debt. Okay, when we angel investors, as we call, angels are the one who says when we are in needy. Okay, exactly, angels can be from our own family, angels can be from our friends, or angels can be of any other person, one who belongs to our own, but it should be a wealthy individual who provides capital at the beginning of the company, at the beginning stage of the business. Okay, so that can be a better idea of another opportunity available, and those type of investors would be called as an angel investors. So, advantages are early stage support, often coupled with mentorship and industry connections. And the third one is a public equity, that we call it as an initial public offering, and that is what we always tell. That is, when we have a owned fund, whatever the fund we have, we will get the share capital, we call it as a share capital, shares, units of shares that has been accumulated either from owner or from a issuing of a shares to the outsider. When we talk about IPO, it is a primary market. Primary market is also called as a new issue of a market. When a company wants to raise fund, it is another sources of financing, which is by issuing of equity shares to the public or an investor, we can raise a fund. So, initial public offering is a raising capital by selling shares to the public through stock exchange via an initial public offering. Definitely, it is another concept. Access to a large amount of capital, increased public profile, liquidity for existing shareholder. You can see whenever in the trade, in the online trading system, if you see the trading system, you can see in every day morning there will be red and green, the decrease in a share value, the red increase in a share value, it is a green combination. That means an IPO gives an opportunity, that is a right to buy of a share, that is what we call it as an initial public offering. Suppose if I have a share, that is an initial, that is why it is called as a primary market, and it is also called as a new issue market. Suppose I am that has been done in a primary market. Secondary market, we just enter into a stock exchange. Okay, stock exchange is another source of another mean where we can raise a fund through our investor. Okay, so that can also be rights issue of a shares, as I quoted earlier. That is also, if already you have an existing, if you are an existing shareholder, if you already have a share, that means if I want to raise an additional capital, I always give a rights issue to buy and issue shares to the existing shareholders, whereas in an IPO it is a new issue. So, it is of a new issue, new shareholders. The third one, so first is about debt financing, second is about equity financing, third one is an alternative financing. Alternative means other, apart from debt and equity, we have got from, that is crowdfunding. What is a crowdfunding? The crowd means it is a group. Okay, crowd, it is a group raising small amount of money from a large number of people, typically through online platform using models such as reward based, equity based or donation based crowdfunding. Okay, that has been reward based in the sense a loyalty card issued by a company. It also can be through points and through equity based. It can be of any combinations that can be raised. And what are the advantages of it? Access to wide base of investor, good for consumer oriented projects, potentials for marketing benefits. When we go for any supermarket and all, we try to go with the loyalty cards, and when we go for a textile, any of showrooms that will be providing in loyalty card, out of which we buy, the coupon rate, the coupons will be given, and that will be initiated as a converted, points will be converted into amounts, converted into rupees, and based on our purchasing and spending, it can be given as an option for us, and that can also be called as a crowdfunding. The next one is grants and subsidies. Yes, grants and subsidies which is being paid by government, and it is completely a non-profit. Okay, non-payable fund provided by government, non-profit or other organization for specific projects or a purpose, like NGOs will be provided and funding, and also for any company, government based industry, government small and sick industry will be provided, and funding for government support will be given in the terms of subsidies. Okay. Now, there is no obligation for advantages, is no repayment required, can support innovation and development in targeted areas. And the third one, leasing and hire purchase. This is also one more type of pattern of alternative financing. Suppose if you do not have a own space, we can lease it. If we suppose if you do not have an own machinery, the cost of machinery has been increasing, because if it will hamper the capital expenditure, definitely we would go with the hire purchase of a machinery. So, acquiring assets through lease agreement or hire purchase plan which spread the cost over time while allowing the business to use the asset. And advantages are spreads capital expenditure, definitely maintains cash flow, access to up to date equipments. Definitely that has been a capital expenditure or one time investment, fixed assets are one time investment. So, therefore, so this kind of leasing and hire purchasing also another alternative source of fund for accumulating of a fixed asset. And the last one is a trade credit. Trade credit is the supplier, that is between a supplier and a buyer. Okay. So, supplier provides goods or services with deferred payment terms, allowing business to improve cash flow by delaying payment. That is when initially if I being a supplier, if you are a purchaser, I will be giving you an opportunity to pay the raw materials which has been required for you, to I will be sending to you, and you in return will be given an amount, I mean time to pay your the amount, okay, to me. That is for a supplier. So, advantage improves liquidity, no interest cost, helps manage working capital. That is why in working capital we will always try to see in an operating cycle time taken to convert your raw material into cash. That is, if you are initially purchasing raw material in a cash, definitely it would be taken work in progress and finished goods, and if you are paying in a credit, you will be hampered. If you because initially you have taken credit and you are selling it at cash, definitely it will not hamper the flow of your working capital. Based on this, that is supplier and a purchaser obligations to give a credit for few number of months, or one number for 1 month or two, depending upon his situation, the trade credit can be happen. So, these are the different types of external financing. So, we cannot discuss only the sources of financing based on short term sources of financing and long term sources of financing. The financing, because when we discuss with regard to online I mean long term sources of financing and short term sources of financing, it is based on priority of time. So, we have to discuss with regard to, first we have to know what is internal financing and what are the fund which has been raised from internally, and what are the funds which can be raised through externally. So, this concept on the previous in the session which has been explained gives in detail about what are the various means of opportunities available both internally and externally. On the basis of this, we try to figure it out which can be taken and how it can be based on a project, based on a time, and based on a priority, based on a combination, that is whether it is a debt or equity we can have in. So, this is a basic concept that has been required. So, when we talk about venture capital, it is an external source of financing. When we talk about angel investor, it is an external source of financing which fall under equity financing. So, this is a concept with regard to types of sources of financing, and we just come to a conclusion with raising of a fund, that is sources of fund can also have a co-concept based on internal and external. Next, based on a priority and how we can divide, how we can further elaborate our sources of financing based on a priority, based on a commitment, based on a time and the obligation. So, we shall conclude the session. Thank you.